So huge challenges in a very complex sector. And I think Peter's going to talk, Peter Gikanga's going to talk to us from the point of view of the regulator in a very fast-moving Kenyan environment. So Peter from the Central Bank of Kenya, thank you.
Thank you very much, Professor Addison. I think I will start on the Kenyan experience. First of all, Kenya adopted the tiered approach. Now, the tiered approach, basically what that means is that we have two categories in terms of the microfinance. We enacted the Microfinance Act in 2006. So we have what we call the deposit-taking microfinance institutions, and then we have the non-deposit-taking microfinance institutions. Now, the deposit-taking microfinance institutions were all put under the central bank. And that's where now the story begins. Because as you will see later on, we will find that the growth in the ones that are regulated by the central bank is much faster than the ones that are not regulated by the central bank. And then also, I think also it is also important for me to also mention the issue of Kenya's blueprint, Vision 2030, which was actually developed in between 2006 and 2007, covering the years 2008 to 2030. And in that one, the role of microfinance and mainstreaming of these small institutions was basically highlighted with a view, of course, to increase the level of financial inclusivity. So in terms of, when you look at Kenya, I know most of you have heard about Kenya, the athletes. I know you know about our athletes, and you also know about our wildlife heritage. But again, I think also the issue of the mobile phone financial services, it is something that Kenya is actually quite being recognized internationally because of what has happened. And basically, for the mobile financial services, what we did is that we did policy reforms in 2007 so that to enable them to play a critical role in promoting financial inclusion through alternative technology-led financial solutions. So you'll find now the telcos, we have like here the equivalent of Vodacom is also in Kenya, it's Safaricom. We have Airtel, and they are really helping in terms of financial access. Now you can be able to do the transfer. You can also be able to get loans using the mobile financial services. And I think I'm going to highlight even some of the key in terms of the numbers. So when you look at the mobile financial services, they have about 127,000 agents who are spread throughout the country. Now that's quite significant because out of that, they have been able to mobilize about 25.6 million mobile money accounts. Now when you compare that with what the banks are doing, the banks are at about 2 million accounts. So you can see the huge difference. And of course, the main reason why that difference is there is because of the huge uptick of mobile phones in the country. So on average, actually, the mobile financial services are actually transacting they used to transact about 1.6 billion in the year 2007. To date, it's about 197.7 billion. This is in Kenya shillings. But when we look at it in terms of the national payments, that comes to almost 70% of the entire payment is now going through the mobile financial services. So you can see that huge growth. And of course, the main reason why that has happened is because of the issue that this one, the mobiles, it will of course cut the issue of the distance, then it will make it faster and cheaper and better to transact using your mobile phone. Even like when you are here, you could still be able to be listening, but at the same time, you're even transacting with your mobile phone. So that has really worked for us, and we are quite happy about that. Then when turning on to the deposit-taking microfinance institutions, as I mentioned, these ones have also grown. So far, we have licensed 12 of them, and they have about 178 branches with about 1.52 million. Of course, you cannot compare it with the mobile phones. The outreach for the mobile is much larger. But nevertheless, we take cognizant of the role that the the deposit-taking microfinance institutions have played in terms of financial inclusion. So now, when I turn now to the outcomes of the reforms, all these reforms, you'll find that we have carried out a national financial access survey 2013, and that one bears testimony to the gains that we have made in enhancing the reach and coverage of financial services to Kenyans over the years. So the survey, of course, reveals that the proportion of the adult population that is now using formal financial services has risen to about 66.7%. Compare that to 27.4% in 2006. So you can see that huge growth, which means that about 75% of the Kenyan adult population is able to access formal financial services. And I think that is the best in sub-Saharan Africa. And then, of course, for the mobile financial services, it has actually more than doubled from about 28% in 2009 to currently stand at 62%, implying a direct contribution of the increased use of mobile phone financial services, which is basically increasing financial inclusion. But then, of course, we've also got a bit of challenges. And of course, the first challenge is, of course, when you look at technology, yes, it's able to increase the digital space through enabling the banking technologies. But the downside is that digitization also poses greater risks, especially with regard to cyber security. That's one of the issues that we are now looking at. And then, of course, again, the innovations are moving much faster than the regulation. And what has happened is that the central bank has basically sort of accommodated these entities. And now we already have the law. The law has now been put in place. But when they came into place, there was no law. But now we have managed to do that. So I think that is one of the key takeaways, that regulation should really be there to, it should be able to help rather than discourage financial access. Then the other area that we have issues is the issue of consumer protection issues. That one has also come up, and what the government has done is that now we have a draft financial services a consumer protection bill. We already have a consumer protection act, but we are now trying to look at the financial services. Can we have something specific for this sector to be able to address the issues and challenges that have come in that particular sector? Then the other one I mentioned, the other challenge that I mentioned was on the issue of the tiered approach, which means that you have the deposit taking on one side, and then you have the non-deposit taking on the other side. So the deposit taking regulation and the framework is robust, but on the other hand, the one for the credit only has been left a little bit behind. And that one now has become a little bit of a challenge and a concern, given that there could be such issues as regulatory arbitrage. And this one, our microfinance, the Association of Microfinance Institutions is currently also trying to update that, trying to come up with a common code of standard for that particular sector. So in conclusion, I can say that yes, there will be, these challenges are there, given the dynamics and the growing complexities associated with risk. But as regulators, as policymakers, I think it is our responsibility to ensure that the regulatory framework serves the sector. Thank you for your attention.
Thank you. Challenges in a fast-paced and changing environment. So how do the savings groups deal with these challenges? Catherine from CARE.
Thank you. So just to give a quick overview of the Village Savings and Loan Associations, these have been core to CARE's financial inclusion programming and have been developed back in 1991 in Niger. The aim of Village and Savings Loans programming is to build understanding of people around financial concepts and also offer financial services including savings, loans and insurance, predominantly in rural areas where there is limited access to other financial services. The model has been replicated by a number of different organisations, and globally we're reaching over 10 million members. CARE is actually reaching 4 million of those members globally, and again predominantly in Africa. The model strongly focuses on women, and this is because we recognise the fact that women are largely marginalised and lack access to financial products and services, despite being the backbone to families and households. So the activities that we conduct under our financial inclusion programmes include VSLA group formation, financial education and business skills training where there is a demand for that. And we've also started linking groups to formal financial institution where the needs arise. Equally, we're now looking at advocacy at both national and global levels. A quick overview on the group's operations. So groups are self-selected and they meet regularly for meetings. They start by pooling together their savings, which are collected as shares and invested in a loan fund. Members then contribute a small amount to a social fund, which acts as a micro-insurance. Then members can take loans from the loan fund at a rate that is decided by the groups. And the leftover money from the group's meeting is then locked away in a cash box with 3 keys that 3 different members of the group have. As the group progress, the loans are repaid at a rate of interest that is also decided by the group. And finally, towards the end of a cycle, which can last between 9 to 12 months, the shares are given back in a meeting that is dubbed a share-out meeting. And they receive back their shares that they had saved, as well as any interest accrued through the use of loans. So that's a quick overview of the activities, and then some of the key principles for the sustainability of the groups. The groups are self-selecting, so members choose other people that they know from within the communities that they trust. The groups are self-managed, so despite going through initial trainings, the groups set up a leadership committee that govern themselves. They also set rules down for the group to abide by, and then they are left to manage themselves. There is also a strict policy on self-capitalisation, so we don't inject any external cash into the groups. The funding purely comes from the group savings that they pull together. And so this has led to numerous strengths in the model. As I mentioned, there's access to savings, credit and insurance in remote rural areas. The model is designed to reach the poorest, including women. Members are able to receive high return on their savings. In our experiences, we've seen an average of 40% return on savings, because that interest that is paid on loans is kept within the groups. There is a 99% repayment of loans, again because of that group cohesion and trust amongst the members and support to repay loans. The model is also a social platform where people come together, they can discuss issues, they support each other. So this improves, we found, self-esteem amongst the women, particularly those who take up the leadership positions within the group. The activities are transparent, and so groups can see what is happening and hold people accountable where necessary. It's an easily replicable model. We've had instances where group members have gone and replicated or gone on to train other groups within their community because there is a demand for it where we haven't had capacity to support. And so we've seen that as an interesting sustainability model as well. And And as I've mentioned, it does have tangible impacts on households when financial when cash flow within the household is better managed. You have increases in spending on education, on health, and equally on investment in businesses. So some of the emerging needs that have come out from savings groups, as they've been maturing, we've found that security of funds become an issue. Many groups are saving quite large amounts, and so we're looking at how we can support that need. Equally with larger loans, there is a requirement for investing in businesses as groups and as well as individuals. So that's also an area that we're exploring. Mobile products have also been mentioned previously. There is an increasing penetration of mobile technology in these areas, and groups want to be able to access their money remotely at a lower cost. There's also demand for asset insurance as well as enterprise development support. And so we've looked at some of these needs as an opportunity to develop products and services with the formal financial sector. Starting first with our savings products and later looking at the possibility of developing credit products for these groups as well. And just looking now at how we've had to adapt the model to certain situations. So we've found that in terms of women's empowerment, in some cases you can find that despite the woman feeling empowered within a group setting, that she's able to manage the finance. The situation can sometimes change when she goes home to the household where the male of the household isn't supportive of her empowerment as such, or questions it or doubts it. And so we've looked at how we can engage men earlier on in the activities to really support and understand the importance of empowering women in that way. So we've also tried to start adapting the model for peri-urban environments. We've come across numerous challenges, first of all in terms of how we actually bring the groups together. In some cases you're working in areas where there is a lot of migration, and so there isn't as much of that social cohesion that you get in rural communities. Equally, issues of meeting space that is available or security of funds have been issues. And again, we've looked at different solutions to adapting the model for that. I think one of the interesting findings has been the higher level of literacy and the access to technology and other products that are available in those peri-urban settings. And so we're trying to look at how we can speed up the graduation process and the principles that we've had in place for linkage to support those groups better. So it's quite a new area for us. We're exploring, we're learning, and we're hoping to share more findings as we come across. I realise I'm rushing, so if any more information on our work is, or if it's of interest to you, please visit our Insights Research Hub.
Well, I have to say the savings groups that we have visited have been quite inspiring, so thank you, Catherine. So we're now just going to go on to our two academic discussants to give us a very brief feedback, and then we will open the floor open the panel to questions from the floor. So we hope to have about at least half an hour of discussion time, both from those of you here and from anybody who's participating as well. And through the video link. So, Tegen, I wonder what you can, what the kind of the poverty issues are and what's your perspective on the very diverse presentations that we've heard today.
Yeah, thank you, Alison. I think we have heard that the overarching goal of this research and this issue is to really think how to make microfinance institutions effective in addressing issues of poverty and unemployment in developing countries in particular. I think we have heard that all the panelists have spoken that their different countries subscribe to this idea of microfinance institutions. But I have a number of issues that I would like to mention maybe 3 points that could also be used as basis for further discussion with audience. The first one is the issue of regulation. I think time and again, the issue of regulation has come up significantly with all countries. As we know, regulation may try to create an enabling environment, but sometimes regulations could also be stifling, and particularly if we have over-regulated environment. So the issue actually is what is to be regulated, to what extent do we need regulation, in what areas do we need regulation, and whether regulation really has an inhibiting impact in terms of reducing innovations and growth within the microfinance sector. But I also feel that regulation alone cannot be a solution. Regulation has to be complemented and supplemented by other support. In particular, regulation is a macro issue, macro thing. But do we really have the necessary environment at grassroots level? Do we have enough financial literacy of the micro and small enterprise owners? Do we really have the kind of saving and credit culture at grassroots level? So to what extent do these countries have tried to really improve the grassroots situation in order to make the MFIs more effective and working for the poor? The second question I want to raise, or issue I want to raise with the panelists, is in relation to this whole idea of microfinance philosophy. Microfinance has an objective of alleviating poverty, addressing social objectives, etc. But at the same time, it's expected that microfinance institutions have to be profitable and have to have, they really have to follow a business model. So are these two compatible? Can we really have viable, sustainable microfinance institutions at the same time, addressing social issues and social objectives? So what has been done in Ethiopia, for instance, the government has tried to allow microfinance institutions not to provide, not to pay profit. That's what we have heard from Dr. Waldai. Do we really need that kind of support and policy and even subsidy to make microfinance institutions work, or do they work as effective, sustainable financial institutions on their own? The last point is, since we are talking about microfinance institutions and addressing the needs of the poor is very much important, so do the products and services provided by the microfinance institutions, are they in tune with the needs of the poor? For instance, one of the things that have come out of this research is that the poor do not have regular income. So are they capable of meeting the requirements of microfinance institutions in terms of providing loans and servicing the debts and the payments as it's stipulated in the microfinance? So I think these three issues of regulations, issues of compatibility between poverty alleviations and the business model, and the issues of the needs and aspirations and capabilities of the poor in terms of the microfinance need to be really looked at, or can serve as a base for discussion, I guess.
Thank you. And lastly, Ashini Mahadevia, who is a well-known in Indian circles for her work on urban poverty, analysing urban poverty. What do you think the Indian experience brings to this debate, a very complex landscape of India?
I think in this context, I would like to raise three issues, though my discussion comes from the Indian experience, but it's relevant for many developing countries which are urbanizing at this moment. The Indian flavor and Indian specific city is a formidable development of formal financial sector, including a very extensive banking system. There has been since last 45 years policies which are directed towards financial inclusion and direction of directed credit policy for poverty alleviation. So this has been the efforts at the national level in the micro policy realm, but the same time, what we still have is a gap between this effort and reach of the financial system to micro and small enterprises, and even very large number of own account enterprises. A lot of developing country cities are actually dominated by own account enterprises, individuals who are working as entrepreneurs in the urban context. I think that the gap can be explained by, firstly, the institutional bottlenecks. And that's true, I think, in all contexts. One is urbanization is an ongoing process. And so there are migrants who come to the cities and attempt to stabilize their lives in the cities. It's a transitory process, and it takes a long time to settle down. The first issue is that what is the citizenship of the migrants, the new residents who come into the city? It's a constant battle of the local governments to define city residents, and that's where a lot of exclusions happen, then inclusions happen. It's a big issue on how migrants and low-income migrants particularly obtain their address in the city, and then through that the citizenship rights. Extending credit in this context is very, very difficult, and all attempts of microfinance institutions have been to go around this issue and attempt to include them. Urban context also brings us another very specific situation, which is not observed in rural setup largely, is heterogeneity of the population. And so to form community and community groups, or as Catherine was saying, to bring groups which we call self-help groups in India, is a very, very complex phenomena. And I think countries, all developing countries, are having somewhat other sort of fissures along the ethnic, caste, religion, language groups. So in the poor communities, it's much, much more divisive forces than inclusive forces. So I think one has to, in this whole context, if we have to look at bottom-up possibilities of inclusion, then this have to be paid attention to. The third thing, and that's come in last 20 years of urbanization process, of what we want to have, world cities or smart cities or global cities and so on, is large scale and repeated and multiple displacements of the poor communities from both their livelihood spaces and from their housing residential spaces. And in that context, to bring about inclusion, to track down community individuals in the urban space is an issue which needs to be dealt with. And fourth issue in the institutional bottleneck is the literacy, and I think countries still lag behind universal literacy achievements, and so to negotiate the financial system is an issue. The second large issue of, as we see in Indian context, but also here, is the globalization and irregularity in the business cycle. So a business that is viable now can soon go out of business very soon if something else happens. So there are exports that happen to the country and so on. So all these multiple retail chains do tend to displace out smaller enterprises. And it's a very volatile, and this urban poor are unable to get a sense and feel of how these businesses are going to move. So as soon as they are able to stabilize in one, and then suddenly they are out of business in a year or two. So in that sense, how to learn, how to go about there. And third, and the most important, that in this situation, and I think what the other speakers also have said, and other countries have expressed this concern, is that there has to be a constant negotiation of in the microfinance space of goals of equity and efficiency. And that is where the state has to step in and play a large role on filling in the gaps when there is shortages. And small experience from India is that recently we had a new policy which says that there would be an opening of bank accounts for everyone. And that the subsidy, that the cost of opening of bank accounts is to be borne by the banking system and probably supported financially by the national government. So there has to be a creative way of subsidizing things. Direct subsidies have not worked, so there needs to be imaginative way of subsidizing the whole financial sector in a way that there is financial inclusion that happens amongst this huge structural constraints that informal sector in the developing countries set up.